Illustration 10. A company can make any of the three products X, Y, and Z in a year. It can exercise this option only at the beginning of each year. Relevant information about the product for the next year is given below. What is it? Selling price per unit, variable cost per unit, market demand, production capacity, fixed cost is all given. First, we have to compute the opportunity cost for each product. So, what is opportunity cost? Opportunity cost is the maximum possible contribution foregone by not producing the alternative products. So what is opportunity cost? Opportunity cost is the maximum possible contribution foregone by not producing alternative products. We have three products, right? If we choose to produce one product, what is the maximum possible contribution that is foregone by alternative products, not producing alternative products? So we have to find the contribution. First, we have given selling price per unit and variable cost per unit. From it, we can find the contribution per unit. Contribution per unit for each item. Contribution per unit is equal to sales minus variable cost. That is 10 minus 6 gives 4, 12 minus 9 gives 3, and 12 minus 7 gives 5. We get the contribution per unit. And next is the number of units that we can produce. Number of units that we can produce will be lower of the production or market demand. Why? Because see here, product X, the market demand is 3000 and production capacity is 3000. Even though there is a market demand of 3000, can we produce the extra 1000? No, because the production capacity is only 2000, right? Production capacity is only 2000 even though the market demand is 3000. So what will we choose? The lower of production capacity or market price. Here also check. So here the number of units that can be produced is 2000. For product Y, the market demand is 2000 and we can production capacity is 3000. Even though we have a production capacity of 3000, is it required to produce all the 3000? No, right? Because the market demand is only 2000. So we will choose the lower of market demand and production capacity, that is 2000 here. Here also the market demand is 1000 but we can only produce, the production capacity is 900. So number of units produced is 900. So we get the number of units produced from lower of market or production demand. Now we have to find the possible contribution or the total contribution. We have contribution per unit and number of units produced. So multiply both these. 4 into 2000, 8000. 3 into 2000, 6000, and 5 into 900, 4500. We get the possible contributions. We get contributions for all the products. Now we have to find the opportunity cost. I have already said that opportunity cost is the maximum possible contribution foregone by not producing the alternate product. If I am choosing to produce X, if I am choosing to produce X, what is the contribution? 8000, right? So if I am choosing to produce X, what contribution did I foregone? The maximum possible contribution that foregone from not producing these alternate products. For producing Y, the contribution is 6000 and producing Z, the contribution is 4500, right? So the maximum possible contribution that is foregone is the maximum of both these contribution, that is 6000. So for producing X, the opportunity cost will be 6000. And for producing Y, what will be the opportunity cost? For producing Y, the maximum possible contribution foregone from not producing X and Z is, here it is 8000 and 4500. What is the maximum? 8000. Opportunity cost of Y is 8000. And for Z, what is the opportunity cost? Maximum possible possible contribution foregone by not producing X and Y. For producing Z, what is the maximum possible contribution foregone? 8000 or 6000? The maximum is 8000. So opportunity cost of Z is 8000. Hope it is clear.